Good morning, everyone. Welcome to the first global rundown for 2016. And that was not the week that we normally expect to see on the first week of the new year. In fact, it was the worst opening week in history in the States, and I would assume the same would apply to here as well. It was an absolute shocker, and the question really is now, what is that telling us? I can certainly say that in my view, circumstances have changed. I'm not saying that this is going to go into a bear market. In fact, I still maintain that it is not. But certainly the approach by which people need to tackle the market, whether you're an investor or a trader, needs to be modified. Otherwise, you're just going to get sliced up. The game has absolutely changed in how we interact with the market. So this edition is really important. I hope you go through it in detail, understand it, maybe replay it, and really take on board what I've put in this video. I've put a great deal of thought and time into compiling this video. So let's get stuck into it. So we'll start first of all with a bit of a bigger picture look at the general backdrop, and it really was a perfect storm to start the year. We had the devaluation of the Chinese currency, which in my view was the single biggest cause of the stock market decline. Yes, there were other factors, but I think this is the big one. This is the one that markets really panicked about. The Chinese stock market went down, limit down, which is 7% twice, and trading was suspended. The second time that it happened in the week on Thursday, the market was only open for about 45 minutes. Such was the speed of the fall. This was because the Chinese authorities had put certain circuit breakers in place. Clearly, those circuit breakers were not well thought out, and they actually amplified the problem. They made it worse. As a consequence of that, the authorities withdrew the circuit breakers on Friday, and the Chinese market went up by about 2.5%. So, that kind of tells the story very clearly right there. Then we also had this very concerning dispute between Saudi Arabia and Iran. And that's not good because that makes people very, very nervous. But I don't think that was the main thing. And then, of course, we had North Korea exploding an H-bomb as well. So, it was really an unbelievable confluence of events that led to an absolute shocker on the markets. Now, I just want to make a point that the Chinese stock market action has pretty much been ignored for years. During the bull market out of 2009 in the S&P index, the Chinese market for most of that time was just stuck around 2,000 points. And so there was almost no correlation between the Chinese stock market and the American stock market. And I don't see a reason why all of a sudden that's going to change. Because the Chinese market is such a contrived market anyway. So the people that are saying that the Chinese market was the cause of the US and global stocks selling off, I think are just plain wrong. So I don't see that it's an indicator for US stocks at all. So I'd advise you to dismiss that one. Now, I don't believe the indices are going to fall into a bear market. However, one has to recognize on the New York Stock Exchange, the majority of stocks are now in a downtrend. It's something like about 73, 74% of stocks are now officially in a downtrend. And some are in a very severe and protracted downtrend. That's certainly the case in energy and materials stocks, but also in a number of other stocks as well. If you look at even stocks like the Hyatt or the Hilton hotel chains, you look at those stock patterns, and they're not very clever either. So there's a lot of stocks that are going down, and the market has been held up, or the index has been held up by the large caps. Small cap indices have failed very badly. They're below their August lows. So clearly you'd have to say that small caps quite possibly are in a bear market. So the general backdrop is that the falls have been mostly about the devaluation of the yuan and all of the impacts that that have on bonds, on emerging markets, on currencies. The ramifications really are quite significant. Now, the value of the yuan has always has been tied to the American dollar, and so therefore it's been an artificially controlled currency. And given the deterioration in the Chinese economy, was always going to have to happen. It was just a matter of how it unfolded, and it's because it's unfolding at a faster rate than what had previously been the case. That's what people are panicking about. So the question is this a mark of significant problems with Chinese economic transition from being an export economy and an infrastructure economy to one of services and internal consumption? Look, certainly there is a slowing down in China, but there is also pretty good pickup in the services and the internal consumption parts of the economy. So I think it is way too premature, and it's just not factual to say that that things are not working in China. We need a lot more time and a lot more evidence to make that determination. There's also a lot of people now pointing towards a global recession as being probable. I think that is just completely unrealistic. It just defies the facts, quite frankly. Money is flowing out of stocks and back into bonds. You can argue whether that should be occurring or shouldn't be occurring. The fact is that it is in the short term because people are panicking. And so what's happening is that we're getting the gap between high quality bonds and junk bonds widening, and that's the way it should be. That gap, that risk gap, had closed to a just ludicrous degree. People were in the hunt for a better return for their money. They were accepting very, very significant risks in high yield junk bonds, but not getting paid for it. They should have been getting rates of 12 to 15%. They were prepared to accept 5. Clearly, that was stupid and always had to reverse itself. And I've said a number of times over the last couple of months that how this played out was important. It wasn't necessarily where it went to, it was how quickly that adjustment occurred. So the move back to normal pricing of risk may be brutal. We've got a lot of leverage in the global system, and that's the problem. When you're highly leveraged and you get margin calls, then quite often traders and investors are being forced to sell whatever they can sell, whatever's liquid, rather than what they want to sell. So quite often you see high quality assets falling in this sort of panic market because people have no choice. They just have to sell to raise cash. It's not that they want to get out of that asset. It's just they don't have a choice. And that's always the problem of excessive leverage. And excessive leverage has occurred because interest rates have been artificially held down for too long, and that caused people to leverage up in order to get a better return. So I think if you ignore what we've just had, the week that we've just had, I think if you ignore that, that's a totally inappropriate thing to do. And I think you're probably you're going to suffer financially if you do. So do not ignore the week that has just been. However, it's also not a week to panic on, as we'll have a look at some charts, because it's by no means a given that we're now going to drop into some sort of bear market. Now, the S&P index, sorry, that wasn't down by 6 points. It was down by 122 points. It was the worst opening week in history. And clearly, we've got another correction on our hands. There's no question about that. We're in a correction. The market is down by more than 10% from its peak. That defines a correction. But whether this will be a bear market of lower highs and lower lows that lasts for 6, 12 or 18 months, I don't believe you can say that at this stage. And until there is evidence that that is the case, then I think you've probably got to look at a more realistic scenario, and that is what I've been saying for months, and that's a continuation of a very volatile but effectively sideways market. The VIX index has bounced up a fair bit. It's up to 27. That occurred on Friday night, so certainly there is fear back in the market. The last video before we broke for Christmas, I indicated two key support levels on the S&P index, 1993 and then 1965. Both of those supports got absolutely blown away in the last week. The market didn't even pause at those levels. So it now looks pretty likely that we're going to get another test of the August-September lows. So that'll be potentially a triple bottom from which the market could rally. Or if that breaks down, then we've got something a bit nastier on our hands. So we need to keep an eye on those important levels. And look, with respect to sentiment, markets are just caught in a big negative feedback loop. There's just no other way to describe it. Bad news is being seen as bad, and even good news is being seen as bad. We had a jobs report during the week that the data was okay, but markets just reacted really badly to it because they're just in a really negative frame of mind. So let's have a look at the S&P index. So this was the daily chart. There was the first trading day, Monday the 4th. It opened with a gap, was down significantly. We had a pause on Tuesday, and then very bad days on Wednesday and Thursday. The market gapped higher on Friday, as you can see. So here was the Thursday close. Here is the Friday open. So there was a significant gap up in the market. You can see how these key levels that I indicated here, 1993, 1965, they just got absolutely blown away. The 1993 level did provide some support on Monday and Tuesday, but then it just completely fell apart. Now Friday it opened higher in response to the Chinese market being up, but as you can see, then the market just completely let go, and we had a huge down day on Friday, and it closed on its lows. Short term, you can see the market is oversold. The RSI is down to oversold level. Here are the August and September lows. So this is critical, down around the 1865 to 1870 mark. If that breaks, that is significant. That's a concern, and we would then probably be looking at, well, there'd certainly be a bit of support a little bit lower, about 1840, but then if that level goes, then we're looking at a retracement of a much bigger range, which really goes back to the lows of 2011. That would take us down to about 1728, which is still a fair way below where we are now. That's nearly 200 points on the S&P. That would be nasty. So key level 1865. I think there's a high probability that level will be tested in the next few weeks. We are oversold right now. Wouldn't be surprised to see a little bit of a bounce early next week. But I think you've just got to expect some more downside before this plays out. Now, if we look at the small caps, you can see that here was the August and September lows. There's the August lows, the September lows, and we've just completely blasted those away. So small caps indices have completely fallen apart. They're now down to a critical level. But if big indices go further, then certainly this will. And that's been a very severe fall, as you can see in the small caps. Just a disastrous fall. So that's the American market. The Australian dollar was trading at 73 cents at the start of the week, finished down at 69.7 to finish the week, and that's largely a reflection of what's going on in China. Now it's at the bottom of the trading range, and it's being priced off perceptions about China, and therefore I think a break of the trading range is really quite a significant probability. The ASX 200 finished down by 306 points on the week. That's the biggest negative week that I can recall reporting for quite some time. And we'll probably see the August lows taken out on Monday because it closed not too far above those. So we'll see those lows break. Now, I must say, though, the Australian stock market, there are some real niche businesses in all sorts of different areas which have moved higher during the last week or two. And their share prices seem to be pretty much independent of the general market. We've seen some really quite strong rises on days when the US market has been down very heavily. So it's as though those stocks just completely ignore what's going on overseas. And frankly, that's refreshing because that's how it should be. If the stock price warrants going up, then then it should do that. So there certainly are opportunities in the Australian market, there's no question. Let's look at the Aussie market now. So you can see here's our August and September lows. We then went down, unlike the American market, we then formed another low in December. The American market was quite sharply higher low than ours. We actually traded down and touched those lows on Friday before a bit of a rally, which was thanks to the Chinese market going up. But you've really got to expect our market to break this level. Now, I don't place too much emphasis on the ASX 200 index because it's really just a reflection of the banks, which form about 40% of the index. But if you want to look at some technical levels, there's really no support now until we get to 46.30. So if this breaks, and I expect it will, then you're probably looking at another maybe 350 points to the downside in the Australian market. So the big stocks, I think, are going to be ugly in the near term. While I'm here, let's look at gold. There's gold on a weekly chart. We got a little bit of a blip up in gold. But look, we've seen plenty of these in the last 4 years since the top in 2011. We had 1, 2, 3, 4, little blip here, 5, 6. So there's no indication yet of any significant change in gold. And if we look at the gold stock indices, this is the HUI, you can see it hasn't even formed a new high, a new short-term high. So gold has formed a short-term new high, but stocks have not. And because stocks almost always lead the underlying metal, then I would expect this gold rally to go nowhere, as we've seen over the last 4 years. So gold ended up higher by $43 on the week. And as I said, I just don't think anything has changed there. So don't buy into the time for gold story yet. We also saw base metals down quite sharply. Copper was down to $2.03 and clearly broke support, as we'll see from the next chart. And all the base metals are under pressure. Crude oil also had another bad one. Traded down into the $32 area, and there's still no indication of a bottom in crude oil. There's the spot copper chart, and you can see that we'd formed a range from early November. That's now broken, and you'd have to say that copper below $2 a pound is now highly probable. So to wrap it up, the overall strategic approach, and these are times that really determine whether you're going to be successful in the stock market or not. Making money when the stocks are going up doesn't tell you anything at all. It's what you do in this sort of market that will determine your outcome, because it's all about decision making and emotional control. And that's what I spend most of my time, trying to help people with. Focus on what you can control. There are things that you can control. You don't have to be a victim of the market. There are many things that you can control. And the first thing is you've got to have a clear game plan. Now, I've been doing this mentoring and coaching and educating function now for nearly 15 years. And it just continues to stagger me that the single hardest thing that I ever try to achieve is to get people to sit down and write out a clear game plan. I don't know why it's so hard, because it's absolutely critical and fundamental, but it is. I guess that's just human psychology. We resist that kind of discipline. But if you want to survive in this kind of market, and I think we're going to have this kind of market for the foreseeable future, and I'm talking years, then you need a clear game plan. If you don't know how to put one together, then for goodness sake, talk to me, and I'll give you some assistance. That's the best form of risk control. A lot of people focus on how do I manage risk? Well, have a clear game plan. That's the best thing that you can do, because what it does, it helps to eliminate impulse decisions, the decisions where you're not sure, and so you just panic and you just react according to your emotions, and almost inevitably your emotions are wrong at these key points. So your decisions need to be based around a plan, and a plan that's built around risk management, and not based on emotion. You know that. I mean, it doesn't even really bear saying, but then again, it does, because so few people ever sit down and write a game plan. You need to know, what are your acceptable risks? What are the risks you're prepared to take? And what are the risks that are unacceptable to you? And the ones that are unacceptable, then remove them, eliminate them. And that may mean not trading in certain things, not trading in the same way that you always have, perhaps trading with more cash available. Whatever it might be, determine what the risks are that are unacceptable to you and get rid of them. Now, I don't advocate selling indiscriminately, of course, but I think everyone should be looking at cashing up to a degree, if for no other reason that this correction will play out. Terrific opportunities will present, and they'll rebound in price, and 10, 20, 30% gains can be made in a very, very short space of time. But you can't do that unless you have cash. It's pretty simple. So you need to cash up to a degree, but you need to cash up in the weaker stocks. And generally that might mean that you cash up in stocks where you're sitting on a loss. And you're sitting on a loss because those stocks have been going down. So don't immediately sell stocks that are in profit and sit on stocks that are in a loss, because you've already realized that loss. So, maybe it's better to get out of that stock and put that cash into something else that is going up. So focus on the weak stocks, the stocks that are fundamentally weak and deserve to go down, or the stocks that just are going down anyway. So that's the best advice that I can give you. It's absolutely critical at these times to have support. Support is far more important than recommendations. So if you feel that you want or need some support, there's my contact details. There's an enormous amount that I can do to assist. I'm talking to non-members here. Members, of course, know the support services that are available and how much I can assist them. So that's it for this week. A bit of a long version, but look, really, really critical that I set the right perspective for the start of this year. Let's see what the next week brings. Cheers.